So this is weekly commentary 42, I believe. So going into this week, we have a lot of red news event folders. Now, before we go into the red news event folders, what they are, right? I want us to compare the last week's economic calendar to this week's economic calendar and understand where we are in terms of time of the month, right? In a few weekly commentaries ago, right? I believe, well, maybe more than a few ago, we spoke about the power of three given the monthly candle. So the idea that the monthly candle is going to open, make a high or low, and then close, right? Now, we have to understand when the likely opposing end of the range for the monthly is likely to occur, and understanding that there is 4 weeks that essentially build up a month, right? So let's look at Tuesday, Wednesday, and Thursday. This is the week going into next week. We have CPI. This is, one of the triads of the three deadly news events: CPI, FOMC, NFP, right? CPI for USD here. We have FOMC as well, and we're coupled by, Thursday with loads of red folders following after it as well. And on Friday, we have the flash services as well. Now, let's compare this week to the week before, right? So this is Monday the 12th, and you saw how many red folders there are just alone in the end of the week. Now, let's compare it to this week that we had for the USD. We had one, and we had another day with the red news, right? So there was 3 folders altogether, 2 days with news, very mild, right? Now, understanding that in every single day, right? Now, if you are new, this may sound like gibberish to you, but the guys that have kept up and are studying the content, we know that there is a Judas swing every single day, and we know the times of day, given the kill zones, that is likely to happen. And on a weekly basis, we can do the weekly profiling, understanding that specific days are more likely to make the opposing end of the range than other days. Now, we can apply the same thing to the monthly candle. Out of these 2 weeks that we saw, which week do you think is going to be an accumulation period, and which one do you think is going to be an expansionary period? The week that lacks the news event is usually going to be the accumulation slow week. And we identified that in the previous weekly commentary. We understood that going into next week, there is not that many reasons to push price around, right? So what is that likely to happen? It's like having a day in the week without news. How do you treat that day to your weekly profile? You wouldn't expect really an expansionary move or an opposing end of the range to have it. For example, let's say there's a Monday with no news events. Tuesday has the news events. You're expecting in your weekly profile for Tuesday to be the manipulation for the opposing end of the range. Now, if we compare it on a monthly level, this week has, well, this week had last week, right? The one we just came out of had really nothing. Now, this week has all, has the punch, all these red news event folders. So, and I say it a few times, and I've said it, in that weekly commentary we had about the monthly power of three. When it comes to the middle of the month, given, we are going into the middle of the month now, you always want to look and consult your monthly chart, right? So let's start with the monthly on the DXY. You want to look at the monthly chart, and you know that your, half of the time of this candle has gone. Look at what the candle has done. So this candle opened, made a low. Now let's identify this, right? We had sell side liquidity here, sell side liquidity, well, this sell side liquidity except that one. And what is this, right? You had a candle and the wick surpassed the entire candle's body, afterwards. So it's a re-delivered rebalance. This is actually a fair value gap. This candle's body to here. It's a fair value gap, and we're inside of it. Now we have this monthly order block as well. This is a re-delivered rebalance because this wick goes through the entirety of this candle's body. So there's an imbalance within this candle's body here, right? Now the monthly candle, we came and we swept this low, and we're inside of this re-delivered rebalance, and it's the midpoint of the month. Sorry. Now we know that A bullish candle is likely to make the open, then the low, then the high, then the close. Now there's 15 days left. Well, more than 15 days. Given when it's the midpoint of the month, there's going to be 15 days left. And we are met now with a week full of a potential expansionary move. And this is how you build the narrative, right? Now, going into the bonds, now why am I looking at the bond? Why would I be looking at the bond? What news events did you see here? CPI, which is inflationary news, followed by the next day, the FOMC, the actual rate that they're dropping. Now, when we see that, we make the link to the bond market. Now, what did we have here? You see how we have this imbalance here, and it's not redelivered rebalance, right? We have this imbalance here, but the DXY is redelivered, right? If we go back to the bonds, sell side liquidity inside of a liquidity void, right? Why is it liquidity void? Look at this candle. This candle, barely any wick. We just opened and we just went. There was no wick that kind of came in here. Like essentially this wick that came down, there wasn't that for this candle going upwards for there to be a gap of fair value, right? Now we went into that. Now, where is the candles given what they look like right now? Where price is right now in the monthly? Where did it come from? Well, we went down lower and we took sell side liquidity and we rebalanced, a liquidity void. So where are we likely to trade to here? Now this is where I'm on my hands for this week, and I'll show you why. So we understand that we're inside a monthly liquidity void and we're pushing away from it. You see here, potentially we can get a market structure shift here on the US 10-year. Now on the DXY, we wanted to see that weekly fair value gap get tagged here. Now remember the relationship from the bonds to the dollar. Where the bonds yields go, that's where the dollar's gonna go. Now in numerous weekly commentaries and just in general speaking to me outside of the mentorship, you know that for the relationship between the DXY and the euro, if the DXY is inside of an order block and we're moving away from it, but Euro USD didn't make it to its order block, we understand that Euro USD won't make it to the order block. It's just going to move away from it because the DXY already traded into its array and is moving away, and the Euro USD's price is being dictated by the DXY. Likewise, the same for the bond to the DXY. If the bond is going to show its hand higher, we may not get the run here. Now, I'm still favoring, I really want to see a push lower, right? I'd rather see the push lower than higher right now. We have the CPI and followed by the FOMC. Now, I expect the CPI to be a Judas and the FOMC to be the actual move of the week, right? Kind of think of it, there's 2 days with significant news drivers. One is likely to be a Judas swing, and then the next news event is likely to be the actual intended direction. I'd rather see the candle, push lower first initially, but I'd rather monitor it given the midweek going into next week, so the Wednesday. Now, we don't trade FOMC. CPI, if it is very range bound before, don't trade it. It's better to let the CPI go as well. Now, I say this every month. Every single 4 or 5 weekly commentaries, you'll hear me say the same thing. It is better to let a few days pass in the market to get a gauge for the next 2, 3, 4 weeks bias rather than gamble and entertain uncertainty and lose percentages of your account if you're trading fundeds or live accounts that you shouldn't have lost. It's a fair trade-off to miss a day or few days to get in line for 1 or more weeks. And this is the kind of time that you should consider that given the news events. Now, let's touch on the weekly and daily. So we're on the weekly right now. I wanted to see the candle move lower. Now, in saying that, when I said last week the candle to move lower, we identified this volume imbalance coupled by these 3 candles being an order block. I wanted to see a midweek reversal, which we did get. However, we just didn't get, the move lower. Now, a portion of that, and it's not pushing blame, but the month that we're in, if you consider the size of these candles, right? Look at the size of these candles compared to the size of, for example, the candles here. For example, just this one candle is bigger than this entire weekly range. It's the time of month that we're getting. If this, for example, was a week given in March, April, May, the Judas swing Monday, Tuesday into here probably would have happened, and then we would have got the move down, right? Given that the ranges are smaller, the move into the Judas swing took, quite long. It took into Wednesday. Although we did identify the Wednesday midweek reversal together on the Telegram, we didn't quite get that weekly, push down lower that we got. I'd still favor a move down lower and keep these highs intact, right? I'm anticipating a move down lower, coupled then by a market structure shift. Given FOMC to, offset it essentially, and it's in line with the bonds. This is where you're seeing the DXY and the US 10-year bonds line up. Now, one thing I want to touch on is this as well. You see this is buy side liquidity. Now, you see how this high was failed? This was engineered to generate liquidity. Above here, there is buy stops. Now, the longer these highs stay in the market, the more buy stops are going to build up on there, right? Now, a run on liquidity that you guys maybe aren't familiar with is this. You see the wicks here, the wicks here, right? So one or two. If the candle's bodies exceeded the candle's bodies here and went into the wick, for example, didn't take the wick, but it went into the wick and the candle's bodies done there, like they closed there, then they went. Consider that a market structure shift. It's if there's wicks and the candle's bodies are trading, over the candle's bodies into the wicks and closing there, and then moving away, consider that. And I'll give you an example. Like the bodies here and the bodies here. You see the bodies of this candle, right? This candle to this candle. The bodies of the candle hold the reliable data of orders in the market. Now, given the candle's body here and here, these are relatively equal highs. If you remove the wicks, this candle's body, there. What's the high? The open of this 990. They're relatively equal, right? From this if you look at the open of this candle, right? 990, 1112, and 1112. The close of this candle is 980. You see how they're relatively equal, a few pips off essentially. Now, say this candle, we had this move higher into it, right? And the bodies of the candle close inside of it and you move down. Consider that a market structure shift. The bodies of the candle. It doesn't always have to run the wicks, right? Now, it's only when the bodies close inside the candles and move away. It's not if you get a wick into this area. No, it doesn't count like that. For example, if you had this was the high, right? And you didn't have none of this. It was just here, and you move up into here, and the candle closed inside of the wick here, and you move down lower. If you remove the wicks, and you only had the candles bodies, you'll see that that was actually a high that got run. Consider those as well, right? Now, on the topic of your midweek reversals, I get asked a lot, how do you consider the midweek reversals? So I have created, I believe this is on a weekly. No. Bear with me 1 second, sorry. So I'm teaching a group in person right now, and I used this demo when trying to explain to them the weekly profile. Now, consider all of these candles to show and represent one day. Now, what we have here is clearly a bearish market right there. Consider this a bearish narrative. And we have a fair value gap here. Now, Monday, Tuesday, Wednesday, Thursday, Friday. You can see that the midweek reversal here was Wednesday. Now, is it always fixed to Wednesday? No. Now, what about if I done this? If I move this candle away, and this is Tuesday, then you can expect Wednesday, Thursday, and then maybe Friday can, come back into the range here. You see how I removed it, and instead of Wednesday trading up into it, I extended Tuesday's range into the fair value gap. This fair value gap represents any price array. Yeah, any price array or a run on the previous week's high, this is what this area represents. It's just I chose a fair value gap because it's visually the easiest one to see. It's about when the day of the week meets price. It's essentially you're moving through the PDA matrix. Now, I could also do this, right? I could say that this was Friday's close price. So this was, Wednesday, Thursday, Friday. No, I could say that this was, uh, say this was Friday, right? Friday, Thursday, Wednesday, Tuesday of the last week. Now, you see how Friday created a swing point, and let's say there was Monday, news folder. Monday moved into the fair value gap because, from the end of last week, we kind of got retraced back into the weekly range. Then Monday could offset the high of the week. It's about when price, meets time. Time meets price, sorry. It's whenever these days of the week meet this. If there was the Monday, then consider the high of the week to probably be placed in. It could be the Monday and the Tuesday, which usually it does that together, or it could be the Monday, Tuesday, and Wednesday. Now, using this, let's go into the DXY, right? Because I get a lot of questions. How do you know? And it's because there's a lot of litter online saying it's this day specifically that does it. No, it's not. It's about when if that day meets price, yes, it can. Now, go back Friday, Thursday, Wednesday. Now we anticipated what? Overall a bearish week. Now we understand from chapter 3, we understand weekly profiling. Not every single day of the week in a bearish week is going to be down. You're going to have a Judas swing that offsets lower pricing essentially, right? Now we had this, right? So consider this like the fair value gap in the example I showed because it's an imbalance, a volume imbalance, couple band order block. Monday, Tuesday went up, Wednesday swept Tuesday's high, and we went lower, and we could have then expected Thursday, and we could have traded Friday lower. You can see that from Friday's open, the range, it favored sells more than the long positions, right? Now, that was because Wednesday met this array. Now, if we go back the week again, so this was Monday, Friday, Thursday, and again, it was a Wednesday. Now, why was it, right? Monday, Tuesday, right? What do we have here? Volume imbalance and the last up close candle. And this was on the weekly commentary mentioned as well. Wednesday hit the PD array display. So you could then expect that to be the opposing end of the range. And this is fractal. Now, you see how in the start of this weekly commentary, we applied this idea, but instead of day of the week, we're considering week of the month. And we looked at the monthly candle, the open, high, low, close. This is a fractal nature of the market, right? It's when a specific, time, so the day of the week, or the time of the day meets the PDRA matrix, this is when you start to consider moving away from it. Now, this is how you need to view the market. Use the daily charts and the weekly charts and look at this and consider these three things, and I've mentioned it to you before. Where is price right now? Where did it come from? Where is it likely to go? Let's consider it for this day. Or let's consider it for this day because it was from this week and we expected this. On Wednesday, and you'd ask yourself this question every single day, by the way, because this is how you sieve out a bias. And if you can't sieve out, then you don't have a bias and you sit out. Simple. Where is price right now? Right? So price is here. Where did price come from? A premium array. Premium array, that's where price came from. Where is price likely to go? Sell side liquidity. So your bias then, you're expecting from here, where is price? Where did it come from? Where is it likely to go? The where is it likely to go and where the price come from? That's called the repricing, right? Now, you as a trader are trying to understand where the market is likely to reprice from where it is right now to the most logical place for it to trade to. For example, this sell side liquidity had my eye. Now, the distance between where the repricing starts from to where you expect it to go, that is the line that you're trading towards. That distance, right? That distance is opportunity for you to find trades until your drawn liquidity is met. Now, this idea is also fractal. You can look at it on an intraday level basis. Where is price right now? Where is it likely to go? That's the area of repricing. Now you're trading the distance. It's very easy. Now, once you learn everything, you're going to realize that once you apply this idea, you you will turn up this if you can stick to this and not get flustered. And the hardest thing to do is when you can't sieve out where is price likely to go, you have no bias because you don't know if it's likely to go and favor one side over the other. So what do? You sit out until the repricing shows its hand. When the repricing shows its hand, you know where price is likely to go. Again, trade the distance from where price is right now to where the repricing is likely to occur. Now, for this week, given that, we spoke about FOMC and whatnot, the next weekly candle, I have uncertainty on it. We swept the previous week's low, right? And we rebound, this candle, we have left no imbalance, right? So it doesn't really make sense to go and trade above this candle's high. But there is many weekly news events that's gonna unfold, and they're the severe ones. Two out of the three are very, large. FOMC and the CPI. So there's gonna be, a large range of week on our hands. Now the start of the week is gonna be very uncertain. I think up until, the CPI moves, I think it will be uncertain. Right now, I don't know which way is gonna favor for the next week. I need that week to pass. I need to see where the market is showing me it wants to reprice. And there's nothing wrong with that, right? You can't understand the repricing after every single candle. If I'd say that it has a greater willingness to go lower or higher from here, I'm just going to be trying to flex muscles that I shouldn't be flexing essentially, right? Let the repricing show its hand. This is the most important thing. Right, because this is where people trip up. They lack the patience and they lack letting go of the ego, and they can't let the repricing show. They need to be a part of every single move and they fall on their face. Let the repricing show itself, right? Now, I'm favoring, soon I'm going to start favoring again the upside of the DXY given because of, the time of FOMC, given, the US 10-year monthly open high low close, and we're going into the week of FOMC now, and it was a bearish candle and the low's been placed in probably in that liquidity void. I'm favoring upside on the US 10-year, so the DXY, I'm gonna start pointing towards higher prices after this week, most likely, given what this week does, right? So right now, for this candle, I'd rather let the next week show itself more. Um, if I do get a better gauge on where I think it's gonna go, of course I'll update you guys on either the private Snapchat story or, of course, I'm always active on the Telegram every single day. Take on board what I said with that example on using the drawn candles. It's when time meets price, right? Now, one last time. You see from here, right? Friday. You see when Monday, we had this volume imbalance. You see from here, there is a larger distance up until this premium array. So you know that a midweek reversal is more likely than a early on in the week reversal. Now let's say this was Friday. Now this was Monday. Let's say this was Friday, and let's say this was Monday, Tuesday, right? You see that how Friday would have brought you close to the PD array, right? Monday trades, Tuesday trades, because you're closer to it, right? You can expect it to happen earlier on. Simple, easy logic, right? Consider like placing in your opposing end of the ranges like this, right? So that's going to be it for this weekly commentary. Just before we do go, I think some of you wanted to touch on the thing. I haven't looked at the US 500 for some time. Now, we traded up into I believe it was a on the daily. So you see how we traded up into here, right? Now you see when we push down here, there's only selling offered, and now you see that this candle offered buying, and you see how it's pretty perfect. And then what was it followed by? Now this was a market structure shift. You had a fair value gap here, and we traded up into it. Now we traded up into it again, and it's full close now. This candle, apply this. Where is price? Where did it come from? Where are we likely to go? inside of the entire narrative that you have, right, you have to first, this is the last thing that you ask yourself for your day-to-day bias. Now we see that we traded up higher into a PD array coupled by a market structure shift. Price swept the previous candle's high, full closed an array. Where is price like to go? Probably lower. This is how you get odds in your favor. Simple process like that, right? So let's end it there. Any questions, of course, ask me all the time. And until next time, I'll see you guys probably soon. I'm gonna try upload the first lesson of chapter 6. So I'll see you guys soon.